Welcome to Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Aaron with us back once again in the studios. How's it going, Aaron?
Hey, John. It's going good.
All right. We're going to talk some really fun stuff today, right?
People love it.
Okay.
You say it.
Oh, we're doing the Beatles tune. We're going to be the tax man today.
You say that because you know I'm a big fan, right?
Right.
Big fan of taxes and the Beatles, right?
Right.
Okay. There was that big tax law change, right? Last tax year. So the 2018 tax year, the new tax bill that was signed by the president, that went in effect that year. So we've had one full year. I should say the accountants and the rest of us have had one full year of implementation of that. And they have made some changes and updates just to correct a few things, especially on the tax return. One thing that confused a lot of people, and I had a client that did his own tax return that got a little confused, and we had to go back, or he went back and corrected. But the big changes, they're going to add in capital gains to the front of the tax return. So it's going to be another separate line item. It was on a schedule, and then it carried over to the front of the tax return as, as part of a whole bunch of other income parts of the return. So that will go on the return as a separate line item. And another thing that confused a lot of taxpayers and accountants didn't like, and they let the IRS know. So the IRS is going to separate pension, annuity, and like retirement distribution money. They're going to separate that. They had it all on one line. They crunched it all together. So they're going to break that out. And there's a couple other smaller things, but those things are what is going to affect most of us, at least on that tax return. I know I'm going to like it more because
I agree with you.
When I go through tax returns with clients, and it's something I do as part of my business, it made it more difficult to try to show what that was, especially for those that get a pension, that had retirement income, that maybe had some money from an annuity. Trying to break that out to see what the cost was in just when we're talking about taxes, how much is that costing a client?
It's a better planning tool to have it that way, isn't it?
Yes, absolutely. And I'm glad they did that. So that's one of the big changes, at least on the tax return. And then there were some things that expired through the tax law that was in an old law, and they kind of put it in there. And there's some college tuition and mortgage insurance that some of they continued and some of they expired. You just got to talk to your accountant about that. And if you fit, 1 out of 100 or 1 or 200 people that it affects, the accountants are up on this stuff. They go through their training, and the software that they use is guiding them, just like it guides people that do their own tax return, to make sure they're filling it out right. But if you have any questions, you can call my office, certainly, but just see your accountant and talk to him. We're right there in that middle of that, the high tax return period. So accountants are hustling right now, and they will be for, another 2.5 months. So I don't know if you're going to be able to have that long conversation with your accountant, but certainly in the after tax season, in the off season, if you want to call it that, people should have more conversations with their accountant about that, especially business owners. I don't care how small your business is, farmers and others. Most of the farmers stay in touch with their accountant. They have long-term relationships with their accountants, but many like small business owners, when I say that, if you have a rental, one or two, or you're right on the cusp, because there's some changes about rental losses or income and losses that affected a lot of people, including me. And of course, I stay up on this, so I knew it was coming. But some others were kind of surprised and shocked that all of a sudden the deductions that they were taking before they were not able to take. So keep up on that stuff. So I had talked in a previous show, maybe 2 or 3 shows ago, about the Secure Act, the new Retirement Act, Planning Act, and we're going to play that again. And matter of fact, it might be next week after this show, is we're going to play that one again. So if you have any questions about the new Retirement Act, that is something, give me a call, 265-3540, and we'll talk about that. So some changes, more changes to the system or the tax system. Tax brackets often change every year. They get ratcheted up for cost of living and inflation. And so if your income is between, is less than $19,750, that's your taxable income after your standard deduction. We'll talk about that in a second. But that income will be taxed. If you're married, the first $19,750 will be taxed at 10%. From $19,750 to $80,250, you'll be taxed at 12%. The next bracket goes up to $171,000, and you'll be taxed at 22%. So most of us out there in listening land, we're going to fall in those brackets right there. And so I tell people, if you could have a lifestyle or a living that is in that 12% bracket or less, which is about $104,000 of gross income, that's the best tax bracket you're probably ever going to be in, because you're going to pay 12% tax on most of that income and 10% on that first $19,750. I think it's in everybody's best interest at tax time or right after tax time, when you get that tax return, go look at the brackets, the ones I just gave you. You can do a search, internet search, and you'll find what the brackets are for that year, 2019, for the tax year that's now being settled now, and look up at those brackets and see what your bracket is, what that higher bracket is. Now, you don't pay income tax on all of that depending on your bracket. So if you have $150,000 of income and you're in that 22% bracket, you don't pay 22% on all that income. It's in that bracket what that tax is. The first $19,000, 10%, 19 to 80 is 12%, and then over that. And I tell people this over and over and again, just not trying to live within that 12% or below bracket. But if you're over that by $5,000, $10,000, $20,000, $30,000, think about deferring that, right? Putting it into your retirement plan or doing an IRA, because you're deferring then 22% federal tax, 4.25% state tax. That's 26 and a quarter that you're deferring. And I don't think you can go wrong with that. So keep that in mind. Go look and see what your brackets are, and you can do the math on it too and see if your total tax that you paid is correct. It should be right to the penny, exactly how much you paid right there on the tax return. Now, there are credits and other things that might, go into effect of, how much tax you actually pay. But the actual brackets, they don't change. They're the same for everybody.
And if you were going to make a contribution to a plan or something, you could still do that even now.
That's right. It's April 15th is tax day this year. Sometimes it's a year or a day later because of the holiday, because of the weekend. But it's April 15th this year. So you have to have that contribution made by the 15th or postmarked on the 15th. I talked about standard deduction. So this last year was the first year that they eliminated, I say last tax year, 2018, they eliminated the personal exemption. And that was that $4,050 that all of us got. So a family of four, would, $4,050 times 4, that's what they got. But that has been eliminated. And they increased the standard deduction. Good or bad, that's the way it is. So the standard deduction in 2018 return was $12,000. This year is $12,400. So again, it increases, so it's not bad. Married couple gets $24,800. If you're over the age of 65, you get an extra $1,300 if you're married. So that'd be $1,300 each. So if you have one that's 65 and one that's 62, only one of you is going to get the $1,300. If you're single, you get $1,650 extra. So that's going to be, you're going to see that ratchet up. And I said that each year, so that 2018 was like $50 less. So it's just going to keep increasing every year. So $24,800, and I show people this, kind of lay their tax return out, and then I lay out these brackets and of course their deductions in another page, and I'll show them how and where they fit. And 99.99% of the time, it's right. Once in a while, surprisingly, it is not right. And the main reason is they got their birth date wrong. For years, the accountant had the wrong birth date in there, so it was never discussed. So it might be 1 year, younger by chance. So I've seen that. Capital gains. Capital gains tax rates are an interesting thing, and they've been very, I would say, generous. It's been a good thing for those of us in our business that are advising people on what type of accounts, what they should invest in, and looking at capital gains and the taxability of capital gains. Simply put, if you have a capital gain, which in this conversation we'll just talk about, if you own a stock that's $10 a share and it appreciates to $20 a share, that $10 of gain, if you sell, will be taxable. It'll at least be on your tax return, or you'll be forced to put it on your tax return. Now, whether it's taxable or not, it depends on your brackets. So those brackets that I gave you, that 10% bracket and 12% and 22%, if you are in that 12% bracket or lower, your capital gains tax rate is 0. So it's a great planning tool for us in our business to control how much tax you're paying. If you're over that 12% bracket and into the 22% bracket, your capital gains tax rate is 15%. So it's not going to 22, right? It's just staying at the 15. So it's still a better rate. So keep that in mind when you're having that discussion with your advisor, or you're looking at your own accounts and information, or your tax advisor. Talk about those things and make sure that, some years, and this next year, I should say 2020 might be a big year. We had 30% returns. Maybe you had a 20 to 25% return in your after-tax account. And there might be a lot of capital gains this year that are because of the selling of stock or mutual funds that have stock and bonds. And there might be a lot of capital gains. So you want to have that conversation with your tax advisor to see if there's ways you can control that. Maybe you have some other losses in your account from stock or mutual funds that you could sell to offset that. Again, your advisor, your accountant, and yourself, if you're managing yourself, you should be looking at that because it can save you in the long run. I have some people clients that are very tax averse, and others, they get it or they understand it and they're accepting of it, I should say. They're not that they get it. Even those that are tax averse, they get it because that's what makes them averse to paying taxes. But, there's accountants out there that, they want you to get to 0, right? But many of them will say, the 10 and the 12%, that's a pretty good tax bracket. And it's probably the least amount of tax you're going to pay in a long, long time. The last thing I'll say is people talk about or ask me questions, and we have a discussion about gifting money, to anybody, mainly children, right? They want to gift money. What's the most I can give to somebody? I never see them giving it, but they always ask. It is $15,000 this year, so you can give $15,000 to any person. So let's say you have a child that has a spouse. You could give, let's say you're the husband, you could give $15,000 to your child, and your adult child, I'm talking, and their spouse, and your spouse, right? The mom can give $15,000 to their child and the spouse. So you can give a lot of money away. Now, you can give up to, hundreds of thousands of dollars away. You just have to do a form if you do that. People ask me, well, how much can I give away? Well, you can give away everything if you want. You just have to do a form. But you don't have to do a form up to $15,000. And I hear accountants talk all about this, and I hear attorneys say this. They suggest that you write on there gift and who it's to. Just, write a check. Don't give cash. Just write a check, whatever, because they're not going to pay tax on that. The whole idea is that if there is an audit or if somebody goes back to look, the IRS for any other reason, and they see that, there might be a question. Well, if you write gift on that check to, little Johnny, it's a gift.
Okay, cool. So there is one more thing that you want to say.
There is. If you have any questions, call me, 265-3540.
All right. Thanks a lot, Aaron.
Thanks, John.
That's Money Talk with Aaron Ricketts, presented by Ricketts Associates, 3245 North Adrian Highway, Suite L. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Join us once again next week for Money Talk here on 103.9 WLEN.